Peter B. Let's see if this stuff is working. I don't know. Hopefully it does. Just waiting for you guys to join. We still got a couple of minutes. Hello, hello. We still got a couple of minutes. Let's wait for everybody. Hopefully this works. Hopefully it works. Yes, it does work. All right. Yes, guys, please join. Just still waiting for everybody. Today is actually a very, very important webinar. We finally are getting to the point where we will start educating you guys about how to backtest strategies. Hopefully you will learn something new. I personally was able to learn these techniques myself in Chicago while working for one of the prop shops, while helping this guy set up the options desk. The amount of knowledge I received was just humongous. It definitely helped me a lot. And we found out that you guys have all the necessary, most of you have all the necessary skills to not only trade but also backtest strategies. So you, even those people who did not respond to the poll about the programming language, everybody has to still trade based on the trading strategies. We did not enforce it yet because there was no no reason for that. It's not that there was no reason for that. There was no platform ground for that yet, but everybody, including those who did not respond to the poll about the programming language, you guys also need to create your trading strategy. So the plan that is going to take place is, first off, thank you so much for filling out the task for completing the task. We reviewed it. We found a couple of mistakes, specifically with the data download, and that's why we addressed that data download thing in the recent PDF. Max, our quantitative research specialist, addressed it, so he's going to be managing you guys, overlooking you guys. He's going to be helping me doing that. We apologize for not sending you any official papers about the internships yet, as again, we are trying to figure out who will be the most qualified people for trading internship and quantitative research internship at the same time. So again, apologize for this inconvenience. You shall receive those the papers individually in your inboxes. Hopefully next week, especially after you guys fill out the tasks. the tasks, so we can double check your skill. So first off, this webinar is super important. It's going to take an hour, maybe hour and a half. Hopefully, I mean, less the better, because all of us are busy. So, but definitely replay it after it's over. And for now, at first, please ask any questions you have. The plan for today's webinar is simple. It's going to be, oh, what am I doing? It's going to be overlooking the task to test gaps. The gap strategy that we sent out to you guys, whoever responded, it has to be tested. And the course of the internship is likely to shape in the following manner. Whoever is going to be trading intern and quantitative research intern at the same time as one title, those guys will be trading and will be testing strategies. And you guys who are testing strategies, you will hopefully, again, learn so much super useful information that you can apply it in your personal trading or at your future jobs, or with us, in case we decide to consider you for the full-time position with us. Again, that will be purely contingent upon successfully developed strategies, like that actually work, that actually make money, real money. The purpose is to teach you not only to trade but also to backtest strategies, because it's one thing to trade based off the news, it's another thing, or based on the news of technical indicators or something that you guys found out, some intuition. It's a totally different thing to trade based on quantitative research, back testing, and again intuition, but a different kind of intuition where you guys have to figure out intuitively by looking at the charts, by looking at the fundamentals, by looking at whatever you guys want, by looking at the pairs, by looking at the baskets, by looking at certain dependencies. For example, metals and treasuries are related, believe it or not, inversely, and metals and oil is very related directly. So those kind of things that you will be able to pinpoint while trading, that thing can be included in the strategies. However, in the first week, in the first two to 3 weeks, you guys will be just testing our strategies and testing your personal strategy as well, because starting next week, I think if we have enough time on our end, we will start asking you guys to submit your strategies so you can start trading based on your strategies throughout the day. All right, it's one thing just to trade. It's a totally different thing to trade based on the strategy. Our job is to teach you how to do that, is to teach you how to, I think, is to teach you how to develop hopefully money-making strategies that you can utilize in trading. So that's the idea. First off, let's, so again, ask any questions you guys have right now, because then it's going to be a marathon of me talking, and you guys will also be shooting many questions specifically regarding the new task, the new assignment. So what I urge you to do is please open up both documents that Max sent you. Again, Max is our quantitative research specialist. He's going to be overlooking you guys and helping manage you guys over this summer internship. He's based in Belarus, which is a country in Eastern Europe, and he is a great asset we have in terms of testing strategies. So he knows the kitchen inside, and he will be helping you guys get there as well. So please open both documents, the Excel spreadsheet and the PDF document with the explanation. 6 people, so 8 people overall responded to the poll. 2 people, one person knows Java, another person knows VBA. Please get up to speed in terms of learning Python over this weekend. If you know C++, Python is easy as cake. If you know Java, you might be actually very useful. I spoke to Max about this, and Max suggested maybe, since I think John, you know Java. I think it might be useful, John, if you actually develop a Windows or Mac application for submitting orders. Because in Belarus, when we held a similar competition, our workforce developed a Windows app that does it. And every single participant did not email us. Every single participant was just using that application. And I can send you a screenshot. Where is the screenshot? I don't have a screenshot, but Max will send me the screenshot, hopefully. And I'll share with you guys of how it should look like. But basically, it's like how many shares, same things like buy, sell, what's the ticker, etc. All that stuff will be in the app that will be directly linked to our mailbox. So, any questions for now? No questions. I don't know if it's good or bad. Honestly, I don't know if it's good or bad. No questions. I think it's bad. So just maybe you have anything about trading, about company, about the internship. If not, we're gonna go ahead. I'll wait for just a minute or two because there's a lag. But yeah, we're gonna be testing gaps, and then we're gonna be working on other strategies. We overall would like to test up to 50 strategies with you guys. Some of this you will be able to use for your own trading throughout the summer. So it will be extremely exciting when you are loaded up with many strategies. Also, Max invited you, I think, to Bitbucket.org. It's like GitHub, but it allows for, it's a very similar service. I think the only difference is that it allows for private groups. For now, everything is public because private groups can only handle up to 5 people. So everything is public, and hopefully you guys had a chance to look through the depository and check out the some things that our Belarus team was working on. And based on these documents, you guys should be, should be starting your thing. Okay, Sihan, can you give us a day trading strategy example? Sihan Ding is asking, can you give us a day trading strategy example? Yes, well, in fact, the one we're going to be testing right now is the day trading strategy. So the one that you guys have to test by the end of this Sunday is a day trading strategy. And yes, we gave you tasks for something more long term. I think it was Dogs of the Dow and Falling Knives, those 2 strategies. But yes, they are very long term. And in fact, I didn't have a chance to look at the Sharpe ratio, but it didn't strike me as something. I mean, I forgot, but it was definitely below 1. So maybe it's not a bad strategy. But again, we did not necessarily test it right. So I want to explain you exactly how we do this, and don't take our view at Brooklyn Devices as like the only view. There are many different views and how things have to be tested. We just want to present our view. And again, we also not married to that view. It's not the only way we know, but it's one of them. It's one of them. All right. So I think there are no questions. So let me just go. So there is a thing called gaps, and that's what you guys need to test. What is a gap? Gap is the difference between stock prices. So gaps can be intraday or interday. Intra is throughout the day. Inter is between the days, right? Basically, the daily gap. So for example, you have a candlestick. Hopefully by now you guys are familiar with them because you're trading. So you have a candlestick like this, and then you have a candlestick like that, right? And this is the close price. Oh, this is the closing price right there, and this is the open price right there on day. This is day T minus 1. This is day T. Yeah. So that's the gap. So basically what happened was there's some piece of news, right? It could be about earnings, could be about the CEO being shot by Batman, could be about buyback all of a sudden, could be about the special cash div, could be about special cash dividend. So it could be about anything. But for the most part, you might see some action taking place pre-market or after-market that fills this gap. But basically, as a matter of fact, this is like a vacuum. So it's a vacuum that has not been filled. And the cool thing about those gaps is they do get closed. And just like we noticed, just like we mentioned in our task to you guys, 70%, that's the number, 70% of all gaps. I think it applies to all asset classes, definitely for stocks. But I think it also applies to all the other asset classes, obviously, aside from foreign exchange, because there are no gaps since it's trading 24/7 almost. It's very hard to find the gaps there. 70% of all the gaps has been closed historically. From the S&P 500, aside from the gap that opened up, I think in the beginning of 2011, like at the very bottom, it just like spunked up. That gap never filled. But except for that gap, every single other gap was filled, 100% on S&P 500. So what it does tell us is it tells us that the market will definitely fall to finish that gap that is open right now in the beginning of 2011, which kind of sucks, but life is life. So we're looking at this 70% of success ratio and say, okay, great. So let's actually test it. Let's actually see what's up since 70% of all the gaps get filled. And our job is to find stocks that do fill the gaps with the highest probability. Now, there are different kinds of gaps. There's a high-low gap. High-low gap is the difference between the high and the low, right? There is an open-close gaps, the ones we're going to be testing right now. I mean, the ones that you guys will have to be testing, like this. It's just close and open. There's also an high open gap. So we're looking at the high of the previous day and the open price of the next day. Obviously, there are many other gaps. Those are just the most popular ones. So again, this is high-low, this is open-close, and this is high-open. High-open. Open-high, let's put it that way. Yeah. So we're going to be focusing on this one just because there are many of them. However, if you guys, the purpose of this internship is for you guys to learn as much as possible, and the purpose is this. You go to, I mean, I don't like to sound a little bit criticizing, but including myself, for the first half year, yes, I was trading, but also getting coffees. You go to prop shops, you don't get coffees, you don't carry coffees anymore because it's all about how much money you make. And what I started understanding just recently myself, just recently, all you guys think that your path in life should be what? Should be, get a job. I mean, first off, go to grade school, then graduate, get a master's degree, and then after that, work for somebody. And that's a great path. However, this path is lacking creativity. This path is sometimes lacking entrepreneurship. This path is sometimes lacking many other things that are basically minimizing your full potential. And the beauty of this internship with Brooklyn Risk Advisors, and I'm kind of like want to sell it right now a little bit, although you guys already sold, but the beauty is you guys will be learning something that you can use yourself in real life. You can actually make money from this yourselves. We're not going to be, you guys definitely will have to, sign the non-disclosure agreements. However, the idea, the thinking that goes behind developing strategies with us, you can try to use similar thinking for developing your own strategies after the internship. And if you have some ideas throughout the internship to do this and you want to share with us, please do, because we might be able to help you out as well with that. So that's why it's extremely, I think this internship is going to be extremely useful in terms of learning, and the material that you guys are going to be learning is not about politics, how to kiss asses, or it's not about coffee. It's like who likes the skim milk and who likes the decaf. It's going to be about actually learning, like actual working knowledge with coding and applying that to trading, and also intuition behind how to develop strategy. Because if you think about this, right, you have the creativity part where you have to develop strategies. Like actually think of them and actually see them and notice them. Then you have the specification part, rather, right, where you have to put the stuff on a piece of paper, right, on a piece of paper, and then you have to code it. Then you have to code it, and then you have to trade it. And what you guys are going to be doing usually is this, until you are 50 years old. And then when you're 50 years old, you might start to think about, oh, should I do something creative? But it's too late now because you already have 5,000 kids. So obviously I'm being sarcastic. Obviously I'm being a little bit harsh. But the fact of the matter is the creative part is always missing. And the purpose of this internship is to give you this creative part. So you can not only code, hopefully trade virtual for sure. Maybe you'll even trade with real money, but also do this and also do this, the creative part, and put your ideas on a piece of paper and judge it. So those are the two things that usually are missing. If you look at high frequency strategies, many of them, I mean, 99% of them are the same, from one prop shop to another, from one bank to another. It's the same. And it's the same not because people magically get to the same conclusion, like Amerigo Vespucci and Columbus, they discovered America, got to the same point. No, it's because they learn from talking to one another. They read the same books. If they read books, and many of them don't even read books, they read the same white papers. I mean, from what I know, Goldman Sachs and JP Morgan, for example, using exactly the same white paper about figuring out, just one of the extreme examples, about figuring out who's going to be the next company that is going to be acquired. They're using the same Tobin Q number. They're using the same white paper that was written 10, 15 years ago. It's a great paper. But the thing is, nobody's really using anything creative. And that's the purpose. The purpose is to make you guys creative. And that's what we do here at Brooklyn Risk Advisors. We are doing creative stuff, right? So long story short, the reason why I would like to focus on that and put your attention on that is because when we give you strategies, it does not mean that you have to just code it just like we told you to. That's definitely a part of it. First off, you have to be soldiers and just doing what we told you to do. That's one. However, you have to be proactive. You found that because our strategies, like whatever we give you, is going to be based on assumptions. We never tested it ourselves. We just think it is true. We think it is true. We want to put it on a piece of paper. We want to code it. We want to see the result. We want to see the Sharpe ratio. You back tested all this stuff, you see that the Sharpe ratio is below 1. Instead of, well, first off, you have to tell us the Sharpe ratio is below 1, but the proactive approach will be the Sharpe ratio is below 1. However, while testing it, this is what I noticed. I noticed 1, 2, 3, 4, 5, and I actually already implemented it and decreased the Sharpe ratio above 1. Would you like me to continue working on that thing? Would you like me to continue working on that specific sub-strategy that deviated a little bit from your strategy? Or you create another indicator that you would like to add that drastically increases the Sharpe ratio. And that's exactly what creativity is all about. Like, you have to, again, now I'm being a little bit like motivational speaker, but try to be a little bit of Steve Jobs while doing this. This is the Wozniak part, Steve Wozniak part. This is the Steve Jobs part. And we would like to develop you into both Steve Wozniak and Steve Jobs at the same time, both creativity and the actual implementation. All right, so that's why I would like to focus on that, because we will be giving you strategies and they will not be working out. And it's going to be up to you. I mean, sure, you can show us the Sharpe ratio is low, and then we can say, okay, add this indicator. Then you come to us like next day, it didn't work out. Then we give another indicator. But this is not what we want. We want you to start thinking independently already. So we give you a direction of thought, and then you use your direction of thought yourself and use your creativity to think something out and to get us a great result, and yourselves as well, because again, those same strategies you can trade on MarketWatch. All right, so that's this. Any questions for now before I continue with the gaps? Because the gaps have to be covered. No questions, I think. No questions. How many people are with us? 8. All right, so almost everybody. That's good. So gaps, we're going to be looking at open close gaps, right? So this is the candle, this is the candle. So we're looking at the close, we're looking at the open. There are different category of gaps, right? You can categorize them however you want. We categorize them based on obviously bullish, bearish. This is the bullish gap. The bearish gap will be, on the other hand, when it drops down. Why it drops down, nobody really knows. But what we do know is that 70% of all the gaps do get closed. If 70% of all the gaps get closed, then there are stocks that close gaps at a rate of above 70%, and then there are stocks that close gaps at a rate of below 70%. So we don't care about those, we only care about these, and that's why we need to run the code and see what's up. And that's what you guys are going to be doing. So first off, there's bullish and bearish gaps. Secondly, each gap has a category. We categorize it based on 1 to 2%, 2 to 3%, 3 to 4%. About 4% chances something really major happened, or the stock is messed up, like FCX, NDP, one of those crazy stocks, like the ones that you guys actually trade. And we don't necessarily want to be with these guys, because these guys are just extremely volatile, and we don't trade options, we just trade the cash, the actual stock. So these are the categories that we would like to look at. Right, 1 to 2%, 2 to 3%, 3 to 4%, same thing here, both bullish and bearish. And each bullish and bearish should be looked at individually. So this is one. This is one category, right? So just open up your PDF. So that's basically the strategy, and then there are a couple of indicators that we would like to add. If you look at the document that we sent you, a 7-page document, first thing that Guangqi Ren have to finish is data downloading. I think, hopefully I'm pronouncing it correctly. Guangqi, you have to, since it seems like you started doing the data download in Python, so you have to finish it up. It seems like you're doing that on Mac. It doesn't work on PC. Well, for us, it didn't work on PC. Just make sure it works for everybody, because because everybody in the team have to use the same code. So make sure you do it correctly. If you don't do it correctly, that's going to be your mistake. Now, ADX and RSI. ADX, it's going to be Korth, Haverth, and any McCall. You guys do ADX and RSI. ADX and RSI have to be done right with the download, so right away. So whenever the stock is being downloaded, the data from Yahoo or Google, whatever you guys prefer, Yahoo Finance or Google Finance, I mean, you have to do the computation for ADX and RSI right away. I included the source from stock charts. ADX, I think, uses 14 periods, and RSI might be using, I don't know. RSI might be also using 14 periods. Just use that same thing. So basically, at the end of the day, you have to have whatever the method you're using, if you're using CSVs or using lists. In list, besides the date, open, close, open, high, low, close, volume, you guys should also have a column of ADX and RSI. Now, the ADX and RSI column, you also have to classify based on the scenarios. It's on page number 2. So these are the scenarios. We have 1, 2, 3, 4, 5, 1, 2, yeah, up to 10 scenarios. Look at those scenarios, but basically what it means is this. You have RSI overbought, and here you have RSI oversold, and here you have a neutral RSI. ADX is so that's RSI. So RSI shows what's going on with the stock. If it's overbought, chance it's going to fall. If it's oversold, chance it's going to go up. If it's neutral, then we cannot say nothing, right? So RSI is an indicator from 0 to 100. Usually the rates are whatever 80 or 70% on top, and 20 to 30 on the bottom, right? I'm not sure what we've been using with Max, but let's see what you guys. They use 70%. They use 70% for RSI on top and 30% on the bottom. Okay. So that's RSI. So RSI shows whether the stock should go up or down. Now ADX shows the trend, whether the trend is bullish, bearish, or undefined, sideways. Now, if ADX is below, again, look in your documents, boys. If ADX is below 20, nothing happens, right? We cannot say nothing. If ADX, on the other hand, is above 25 and DI plus is greater than DI minus, then it's bullish trend. If ADX is above 25 and DI plus less than DI minus, then it's a bearish trend. Based on these things, there are 7 scenarios of the market because gaps can be working differently in different markets. For example, if you see that there is a bullish trend, ADX shows that it's a bullish trend, and RSI shows that the stock is overbought, and then there is a bullish gap up right there. It's clear that chances are, using those scenarios, it's a way high chance that the stock will actually fill the gap on the same day. On the other hand, if ADX is going down and RSI is oversold, and there's a bearish gap, then again, there's a high probability that this guy will actually go up, right? So this is RSI, this is ADX. And we mentioned specific scenarios. So again, Court and Andy, you guys have to work with Gwanki to make sure that you do the data download, ADX and RSI for the rest of the team. And classify everything based on the 10 scenarios. So that's your first assumption, first task. Now, Aki, Sihan, Gwanki, and Han, you guys have to move into page number 2, strategy 1, open close gaps. So here you guys have to actually do the statistics. So go through each stock. Look at the category of the gap, bullish, bearish. Look at the category of the size of the gap, 1 to 2%, 2 to 3%, 3 to 4%. It's going to be all open close gaps. So open day T, divided by close T minus 1, minus 1. This is the size of the gap. Whether it's bullish or bearish, doesn't matter. Well, of course it matters, but I'm just saying. Here you have to categorize that based on the, again, based on the categories 1 to 2%, 2 to 3%, 3 to 4%, based on whether it's bullish or bearish. And then you have to do the signal, right, to compute the PNL. So what is the signal? Like what is usually happening? What do we expect? How to trade the gap? Let's say that this is the situation. The classic example is to say, all right, cool. Let me short right here. The price target is going to be at yesterday's close price, and the stop loss is going to be whatever. So we assume the stop loss is, for example, 2%. So if the stop loss is 2%, then the next day, like here, it can go up to 2% max, or we'll close out, and then it has to fall off and fall off and do the fill the price target right here. Once it finishes the price target, we exit. So how to identify price target and stop loss? You know for sure that this is the open price. You know what is the low. You know what is the high. Since you're shorting, your stop loss is going to be, so you have to say that 1 minus, since you're shorting, so 1 minus high over open has to be greater than or equal to negative 0.02, which is 2%, if I'm not mistaken. In that case, the stop loss did not get triggered. Then the price target, on the other hand, will be 1 minus low over open. That thing has to be, actually no, for the price target, you just said that the low of day T has to be greater than or equal to the close on, sorry, less than or equal to close of T minus 1. In that case, the price target got hit. So those are the exits. So the first exit is based on the stop loss. The second exit is based on the price target. And the third exit, in case it never hit the stop loss or the price target, is you close based on the close of day T. So you got 3 options for the close: stop loss, price target, or the actual closing price on the same day. You're assuming that you're only holding the position for 1 day, for 1 full day, and you entering on the open. So this is the first classic strategy for gaps. Any questions at this point in time? Because it's going to get a little bit harder, a little bit more complex. I'll wait for a minute or two for you guys to process. And nothing too hard. All this stuff is really explained in the document. I just want to give you some better understanding of what's going on. Waiting for a minute or two again, and also taking a break, a quick break. Hard to talk. It's very hard to talk non-stop. All right. Kurt, does reach above the stop loss or go below the price tag? What should we do? Closing price. Very good question. Closing price. So, yeah, you know what? Let me just draw this not in candlestick. Let me just draw like whatever the stock was doing like this, going like that, then it gapped out, right? So, if it didn't reach the stop loss and did not reach the price target, you just do close it on the closing price, as it's going to be the closing price of the day. Because you can have exits can be based on many different scenarios, but for the most part, exits and entries are based on either timing or pricing. So we got pricing in terms of stop loss and price target, and we got timing in terms of 3:55 p.m. Or whatever, 3:59 p.m. EST, like 1 minute, 5 minutes before the close. Other questions? And please shoot questions even if I'm not asking you. Please shoot me questions because that's very important. I want you guys, again, that's not super, we're not doing like a rocket science here. I understand. But we're actually not far from the rocket science because we have to create a system so easy that we can add new criterion later on throughout the entire summer and actually make the goal, make that strategy and those strategies that we're going to be working on into a golden unicorn. Okay? That's what we have to do. Okay, no more questions. Cool. So same thing applies to the bearish gaps, right? So the stock is going like this, then drop down. If it did not reach the stop loss or did not reach the price target, then close on the closing price. In case it did reach the stop loss, you first do the stop loss, then do the price target. Question is, you guys only have daily data, right? You only have daily data because we expect you guys to do this based on the data over the course of the last 5 years for each year. How do you do this, right? How do you know which happened first, stop loss or price target? You don't. We don't. So you just say, you know what? Let's come worst comes to worst. Let's just go over the stop loss always hitting first, even if it didn't hit in theory. Hit it first, and yes, the Sharpe ratio will be worse. But guess what? If even in this scenario the Sharpe ratio is good, then in real life it's going to be amazing. Hopefully you guys understood what I mean, right? Because we don't know the sequence of what happened first. We don't know the difference between give me a second. You don't know the difference between this scenario. It's like this, right? Or that scenario, right? Because in this case, we definitely made money right away. In this case, we first off lost money and then we made money. We don't know, but we assume the worst scenario. You know what? We say basically, Who cares? Let's go for the negative 2% right away of the stop loss. So the iterations, look at the document right now. The iterations that you guys have to do, the different scenarios that you have to do for strategy one. You four of you guys, Guanqi, Han, Aki, and Sihan. You guys have to first off play with the stop loss. You have to play with the stop loss. It has to be 2%, 1.5%, 1%, 2.5%, I think 3%. Whatever is in the paper. So you have 5 different stop losses. That's one. Price targets. Sometimes, oftentimes, in fact, the stock does not get back to the close of the previous day. It might have some increment, right? So you do close T. That's your first stop loss. Second, first stop price target. Second price target is close T minus 0.25%, and then close T minus 0.5%. Obviously, minus 0.25, minus 0.5, I'm talking about the bearish gap. Here, for example, that could be a negative 0.25%. For the bullish gap, it's going to be the pluses here. Close plus 0.25% and close plus 0.5%. All right. So that's this. Now, so those, so you have iterations, different iterations for stop loss. You have different iterations for price targets, and you also have different iterations for the entries. We assumed that this stock gapped down and we buy it right away. But guess what? Oftentimes at the momentum, it just drops down, especially if it's a volatile stock. So why would we enter here? Why not enter here a little bit down? And we call this a jump. So it's going to be, say, a 2% jump. So now this is like, say, a 3% gap, 2% jump. So overall, our price target is 5% if you enter here. And our stop loss of 2% drops down to 7%. Now imagine this. How many stocks can drop 7% in one day? Not too many, right? So the jump actually makes a lot of sense. Sure, you'll be missing some opportunities, right? Because if the gap opens up, it just shoots up right away. You miss the opportunity. But you know what? This opportunity, this one, is a little bit more risky, and it probably will give higher payout, and it probably will give higher Sharpe ratio. So you have to do that too. So you have entry, exit for stop loss, and exit for price target. You have different levels for these. It's all in the document. So you have many different scenarios that you have to test for every single stock. You have 72 scenarios. So you have 6 scenarios for the entry, 4 scenarios for the stop loss, 3 scenarios for the price target. Total of 72 sub strategies. So you can call them, like in Python, you can call them, the best way to call them is, since it's strategy 1, so you call it strategy 1.1, 1.2, 1. Whatever, 1.72, and create a README so we know which one is which, and just describe which one is which. Now, each stock, you run this, each of these 72 strategies for every stock, and you figure out the stock with the highest Sharpe ratio. So the limits we have is Sharpe ratio above 2, number of signals in 5 years, every 5 years has to be above 20 at least. I know that 20 is little, yes, I understand, but still do 20. And you have average signal return is above 0.5%. So those are the 3 metrics. Chances are you will not be able to find too many stocks like this, especially for 2 to 3% gaps and 3 to 4% gaps. But guess what? Use your creativity. Get me more signals. If you get me 1 to 2%, lots of signals, go. That's good. That's very good. Questions for now, because again, that's only the beginning. It's not that it's at the beginning. It's honestly almost the end now, I think, because once you understand this, everything else is easy. No questions? Okay. So I'm continuing. Please ask if anything. So those are the things you have to test, right? So you have to select the best strategy for every stock. And those stocks that do not apply for any of these strategies, they do not qualify, they're just out of the game. We start with S&P 500, but chances are we're not going to find too many stocks from S&P 500. So if you want to add Russell 1000, do that. Now, what is testing? What many people do is this. They say, all right, cool. So I have 20 years of data. Let me do this. No, I have 57 years of data. Let's go from the Second World War, 1945 to 2015. Look at the gaps or like look at the strategy and apply it for 2016. This is very good, but guess what? It does mess for the curve fitting. So now I'm gonna give you something super sacred, super secretive, and I'm not bullshitting. What I'm gonna give you right now is this shit. It's really, really interesting. It's really cool. So check it out. Many people will tell, all right, cool. So that stock, oh, there was a dip, and now it went up. And when you looking at this post stack, you're like, oh, no, I mean, yeah, sure. It's like, I mean, there was a dip here. Like, yeah, you should definitely buy. But guess what? When you, let me find the rectangle. Well, when you don't know that this is going to be gap, when you don't know that it's going to be anything, like when you're not sure how to, let me just draw this thing. I just want to draw it. I want to show you. Just want to show you the cool thing. I don't even know how to draw in paint. Wow, this is, oh, it's right there. Cool. So, but before this thing, right? If you put your right hand or left hand to the right of the chart, you don't know if you should buy in a dip. You don't know. You only know after the fact. And that's exactly the problem. And that's exactly why curve fitting exists. And this is what I'm going to show you. And what I'm going to show you is extremely useful. What you do is this. You look for, like if you have a brilliant strategy, you look for, say, 5 years, 2011, 2015. You look at these 5 years, and then you predict for 2016. But before that, using the same selection method, what you should do is this. You should test 2011, 2014, and forecast it for 2015, which you already know. You already know 2015 data, and you can test whether your selection criteria was correct or not. Then you go one more year, 2010, 2013. Well, I'm obviously messing up 2010 here, 2009, 2013. And you're looking for 2014 data, and you're looking for the P&L there. At the end of the day, what you should have is you should have a P&L for 2015, 2014, 2013, 2012, 2011. This is something they don't teach you anywhere, not in school, not at work, nowhere. So what you should do is you should test it 2015 using 5 years of data. You should test this guy. You should test that guy as well. And then if the criterion selection method is correct, then you apply it for 2011, 2015, and give us values for 2000 stocks for 2016 to trade. This is the most honest way to test things. And this is what we want you guys to do. So for every one of these years, you guys have to go, strategy one, guys responsible for it. You guys have to do 72 iterations to give me the best set of strategy for every single stock and the historical P&L. Compute the P&L, compute the average return for that particular year. And then we're going to compare that to the S&P 500. All right, so that's the nutshell. This is strategy one. Now, strategy 2, 3, 4, same concept, but way more harder in terms of computation. So, any questions, guys? Please think about any questions you have. Because at the end of the day, the output that I have to receive is 2010, 2011, 2012, 2013, 2014, sorry, no 2012, no 2010, 2015, and then 2016, the set of stocks that apply for the same selection method. And all these guys tested. All these guys tested. Every single year. Any questions? It's very, very important. Extremely important. Okay, a couple of minutes. Waiting for you guys to ask questions if you have any. And this is why ADX and RSI have to be completed, Cord and Android. you guys have to do it, Andy, right? You guys have to do it as well with download, so that everybody else can have access to the. Because strategy number 2 will be contingent upon those scenarios based on RSI and ADX. Guys, come on, no questions? No questions means you don't understand, or you understand, one of the two. And I don't think you guys understand. That's my intuition. So please ask me any questions right now. This is a day trading strategy. You can use it almost every day. There are just myriads of those gaps every single day happening. Every single day. There are 10,000 stocks. If you look at the most liquid ones, you can take Russell 1000. It's going to be crazy. All right, no questions, moving on. So this is strategy 1. So it's all in the PDF document that you guys can find on Facebook. Moving on. Before you go, the hints, right? What you guys gonna do for the most part? Chances are you guys gonna do. All right. So I have 500 stocks. Let me just test all 500 stocks right away. Let me just run that thing for like 5 years. My computer will be working nonstop for 5 hours, and I'll do it. No, this is the wrong approach. What you do is this: you select 20 or 50 stocks. You can select them based on the sector. You can select them randomly, whatever you guys want. You can select them based on market capitalization, dividends. It can include different categories. They're different groups. Whatever you want to do. 20 to 50, and you do that analysis on 20 or 50 stocks, because the analysis will be at least 10 times faster, if not more. So what you do is you do that on 20 to 50 stocks, and if that method works, then you apply it. If your code works, you gotta debug all the mistakes potential. Then you're gonna move to the 500 stocks. At the end, once you totally successfully identified that the algorithm works. Cool. So that's this. Now, so those are the useful hints. Now, you can also find the blueprint of how it should look like. I mean, it's not how it should look like, but what we did like really quickly in Excel for you guys. Files BRA week 1. In Excel, you go to the OC gaps tab. You look at strategy 1. You can, in the summary tab, you can change the ticker, and you'll see the results. So what we need is the list of stocks and the criteria which we discussed here that gave you guys those stocks. So with the years, with the P&L by year split of 2011 to 2015. Now, strategy number 2. Same people responsible: Aki, Xian, Guanqi, Han. Working with Cord and Andy on this. Cord and Andy will give you RSI and ADX from the data download, and you guys have to look at the scenario 6, scenario 3 for the bullish gaps, and scenario 4, scenario 7 for the bearish gaps, and see if those scenarios help improve the Sharpe ratio and help improve the profitability. Strategy 3: open close gaps plus trend slope. This is where we start improvising. This is where we start thinking about new things. So there's a trend, right? So you're looking at this, that, whatever, this, right? How to identify the trend. There are different ways how to do that, but the best way that we found so far to make sure that whatever the line we get is actually very similar to the XY coordinate is you take Y values as close prices, you take X values as open prices, and you do the regression line. You do the regression method and you figure out the slope. You figure out the slope Y equal MX plus B. Now this M is the same thing as tangent of alpha of your line. And you need to find arctang of that alpha, and then you need to compare what's going on. So, and then if the arctan is in between certain regions, like for us, we said it's going to be like 20 degrees, 30 degrees, etc. If it's in between those lines, then you guys do the analysis, right? So we again assume that if it's a bullish trend and there is a bullish gap, chances are this gap will be closed. On the other hand, if it's a bearish trend and there is a bearish gap, chances are it will be closed because at this point of time the trend is oversold overbought. Now, so that's this number. This is strategy number 3. And finally, and you also have to like look at the number of iterations here. It's about 2,000 sub strategies because there are different degrees that we want you guys to test, and there are different number of days that we want you guys to do the linear regression on. So it's anywhere from 6 to 10 days for the period, and it's anywhere from 5 to 10 days, and it's anywhere from 20 degrees to 40 degrees with the increment of 5. So these all could be found in the document. Same thing. You look for the best stocks for a given year, and based on these best stocks, you do the measurement. And finally, strategy number 4 is the same gaps plus open close volatility plus the volatility. So volatility could be computed, historical volatility could be computed as you do daily change, and then you do the standard deviation of the daily change, and it will change based on the period. The period can range from 5 to 10 days. From 5 to 50 days. There are specific regions we guys gave you in the doc. It's 5 days, 10 days, 20 days, 30 days, and 50 days. And the total number of sub-strategies is almost 1,500, so 1,440. So you're looking at the full volatility period, you're also looking at this. So say the volatility is like this, right? Say the average is somewhere here. Now, the more volatile the period, the high chance that the gap will actually be closed. The lower the volatility, meaning that the gap will probably not get closed. So the higher the volatility, the better for us. And we're looking at, so this is the average, and we're looking at the period that doesn't force the gap closeout ratio on day 1. And that could be average plus some X. And that X will range, it's all in the document, that X will range from 0.5% to 2%. So it's going to be 0.5%, 1%. So average plus 0.5%, average plus 1%, average plus 1.5%. Sorry, not average, rolling volatility. Rolling volatility plus 0.5%, rolling volatility plus 1%, rolling volatility plus 1.5%, rolling volatility plus 2%. So those are the rolling volatilities that you also need to inbuilt in your strategies. Now, the way how to build this thing, the best way, is to make sure that you build kind of a system that you can later edit. And Max will be looking at you guys. He'll be helping you. So we gave you access to the Bitbucket depository. That's where you can do all the magic there. I think we gave you access to all the documents that we have that the Belarus team is working on specifically about this on this strategy. So you guys can look and see what's up, and maybe save yourself a little bit time because the logic is all there. Besides volatility and trend, everything else is there. I think. Scenarios are definitely there, and the gaps are definitely there. So, any questions at this point of time? I think this is like we're about to wrap up, and I think this is the final floor for Q&A for this. I mean, as part of this webinar, the rest will be conducted over Facebook. Okay, no questions yet. Waiting just for a couple more minutes. We're gonna wrap up. Thank you for attending. If you want to start, I urge you guys to start today. You have a lot more really cool things to test. Really cool things. So if you're fond of back testing, fond of figuring out that alchemist stone, then you are in for a ride for sure. Okay, questions. One more minute. One more minute. Okay, if you guys have any questions, please ask Max or myself in Facebook. I'm not sure how Bitbucket works in terms of committing, but you definitely can commit there whenever you start. It's all public for now. We're gonna close it down once once we identify the group of people from you guys. If you have any questions, Facebook, please reach out to me, Ted or Max. Thank you so much for your time, and we will talk very, very soon. Thank you. Bye bye.